FutureSpeak, May 1st, 2019. All right, what I did was waited till the FOMC news came out, just after 1 o'clock here on Wednesday, and the market moved up slightly after that news came out. Basically, the Fed said no change. They're still, going to be patient on rates. They see low inflation. They thought consumer spending had slowed, business investment had slowed, and at the same time, economic activity had increased. So there's a lot of conflict in there. We saw this morning ISM and construction spending were both weak. So the Fed is just clueless, and they're just holding where they are right now. And the markets, essentially, the stock market likes that. The stock market is kind of an island in the sky here, as there are a lot of things that are going on around in the commodity markets that suggest that there is actually a real slowing going. We see bonds moving up at the same time that stocks are right now, and it's like there's some money moving in there. They're trying to get ahead of something, and maybe they see copper looking like it broke down, and metals also overall turning weak, grains just crumbling in there, and all of this is a background for a negative economic scenario. But stock investors, they say that as the Fed still pumping in all this stimulus, where we have a 2.25%, 2.5% Fed funds rate, and an inflation rate that's just around that level or just under it. And so you have no real interest rates whatsoever. It is an extremely stimulating type situation, but yet commodities are really weak. So it's a odd picture that we're looking at right now. And when we look at the stock indexes, I'm going to show you the extremes that they're in right now, and how when this happens, you often get some very sharp pullbacks. And that would be in line with our belief that the biggest decline would be towards in May, maybe towards the end or beginning of June. And we still think that's a very high probability. So I will show you that as we move forward. Let's switch over and look at our charts right now. As we start out in the energies, we're going to show you energies, foreign exchange, metals, treasury, stock indexes, and the grains and softs. And let's start out in the energies. Now, we had expected that the energies were going to get into a correction, and what we saw was a very similar situation in the energies to what we have in the stock market, where they had moved up a lot consistently and had been in positive momentum. And now we're starting to get a sense for that's changing. Now, there's not a lot of time in these cycle patterns for correction. Just as we said, in the stock market, we thought it would be brief, a sharp downside move. This is the weekly chart right over here. This section over here is got 2 or 3 weeks of potential correction down over here. When you look at the daily over here, you actually have a breakdown already, and we're losing momentum. And that points to about a week and a half or so of decline right in here. So this correction that we're in, we actually think it's going to be relatively brief. You can see the weekly pattern projects down to the 23.6%, around $61. Sometime in the next couple of weeks, $2.50 or so risk on the downside. That's we think likely to be the worst of it. And when we look at the daily chart, the same thing, a couple of weeks in here coming down. This is about $61 also, a little bit above it. And that's what we think we're going to see. Now, the upward momentum, which on the daily chart, our short-term measurement is the slim ribbon, that is a very clear picture of all of this upward momentum, turns bullish here and stays bullish this whole time period. Now, I want you to note it's at risk now of neutralizing. It's very close to neutralizing at this point, and we're also in a condition of a breakdown. So the cycle support low has been broken. That then confirms or makes the probabilities more than 70% that we are now in a declining phase. This looks to us like a bear flag being formed in here, and that we're likely to get an acceleration again to the downside. So is this relative to just a normal correction? Is this relative to the negative commodity markets we're seeing and actually slowing economies? There's good reason to believe that there are issues here. And all of this about OPEC and the sanctions against Iran and the problems in Venezuela, all of that really brings the question whether or not that can overcome what are continued growing U.S. production numbers to offset all of these problems. I actually don't think we're going to see a lot higher prices later in the year, whereas that number that we got up there at 66 and something may only be just barely surpassed out here in the summer before the markets then start to do poorly. But right now, you can see the condition is that there's a stronger likelihood we are in a correction right now that will take it down to $61. /RB is the next one we're going to look at. You will note the similarity. Had this upside move right over there. I said rare abandoned baby, and actually after the roll, it actually became a shooting star. So that needs to be changed. That's really just a shooting star right there, and we'll just correct that right there because the roll took away the abandoned baby. It's pretty close, but that peak in there came, and now this points to a potential longer correction out here, depending on how it acts based on the shift. So we're looking for a decline here to about 193. It might have a little more time than we see in the light crude market. Now here you can see it's still holding up a little better in momentum than light crude is, as the slim ribbon has still been strong. It came down and hit the 23%, the middle of the slim ribbon, and now is trying to tick up again. So this is a little longer pattern than we're looking at in light crude, and this one could actually correct for a longer period of time. And that might actually be out to, let me look at this right here, out into later in June. Similar situation to what we see here in the daily. So that's why we have it projected out further. And the gasoline market to us looks like, again, it's correcting and just starting that. We'll probably have a few days of attempted rally, but then we think it's going to break down. Heating oil /HO. Let's go back to the weekly chart. And you can see a nice rebound in here. It looks like it has a couple of more weeks to go of that correction. It got into that sell zone and really started to stumble the last month. And when we look here, you can see it's trying to rebound, but we don't think it's going to last a couple more weeks, in line with the light crude market coming down and here towards the end of May. So we think that this rally in heating oil is shortable when we look at that. Natural gas trying to get something going in here. It's bouncing, but we think it's not going far. And we'll blow this up right here. And you can see it trying to bounce, but you can see it's in the red zone way down over here, which makes it extremely unlikely that it's going to get very far. And I wouldn't be surprised to see, just a matter of a couple days before, or minutes before it starts to move down again. This pattern right in here looks like it will resume again to the downside, and we'll be looking for about 246 again as it probably tries to equal that low. You can see the momentum in here remains negative on the downside, and every time you have negative momentum and you get overbought, as you did right over here, and it turns down, you get declines. Well, that's the situation we're in right now. So the highest probability, based on this pair of studies, the slim ribbon and the projection oscillator, suggests that the rally that it's having right now is likely to fail. So that's a look at energies. Energies basically looking at light crude, and the products are in a corrective mode, and that we're likely to see a move down in light crude to around $61 is what we see. So the dollar is also in corrective mode, and this is timely. And that is lining up with lots of things that we talked about before, especially the period of dollar risk based on the period of likely rally in the euro currency, and that's coming to fruition just beautifully. The British pound getting a little boost from that also. And I think you're going to find this fascinating when we look at this. So we looked at the dollar as being in a period where it was likely to pull down. Now, it's amazing. We have the stock market in this extended period with only a brief time left for correction. We have the light crude market, I showed you that, and the dollar also. So the dollar came up and hit our projections up there for the year, and now has started to back off. So we actually believe it's got another few weeks in here, and then we'll get another rally period. But when you see us projecting out this way right over here, the reason for that is because we're taking into effect this cycle right here that we think is going to start turning down. So this rally is the one that we drew on right here that we think is going to be substandard. We'll look for a break in here down to this 38%, which is at around 96.70, potentially down to about 96.45. And then after that, we think it's going to put on a rally that isn't going to go very far. And all of this out here is the period where we think gold is really going to do a lot better. And it actually is firming right now, and I'll show you in a couple minutes that we're getting to the period where it's likely to be bottoming, the gold market. So you can see this steep move down as it hit that target zone up there, following that pattern beautifully. And our expectation being that we're going to continue down for the next week. Getting here, this is around 97.07. It could get a little lower than that. If it breaks these levels here, it would be a breakdown. And we're in this lower support area right now. So we'll see how this acts. I don't really expect that it's going to continue to free fall like this. And at the same time, look where we are in this cycle. So it leaves all of this time period. So anything can happen here, and certainly could continue down in a big way as it is breaking right now. So interest rates in the U.S. falling right now, and with the bond market 30 years up 25 ticks, and that is negatively affecting the dollar. And somehow this is not in alignment with what the Fed says is going on. You really got to wonder if markets are worried that they don't know what's going on when you look at that. So that dollar right there moving down as expected nicely in this pattern, with likelihood that we're going to see stair-step downward motion in here for a long period of time for the dollar. And when you look at the euro /6E, that really enhances that thought process, because what we had talked about was a reversal in the euro coming, and that this period of risk would bring this decline, and it would bottom sometime around here, and this is the period of rally for the euro, which is the period of dollar risk. And you can see this big up bar right in here. That's engulfing the previous week. It's only on Wednesday, but that looks really very much like a bottom of significance. And when you look at the location here, and you know that it's 50.57% of the dollar index, this is not a good scenario for the dollar. And it is also a very good scenario for gold. So it really looks like we could start to look at money shifting into the gold market based on what we're seeing in here. So that is a look at the weekly, and this is a look at the daily. Now, this, you can see that there are 3 cycles, 1, 2, and 3. Look at this. Now, this looks like an early bottom. It might get some kind of a pullback in here over these next few days. The dollar get a small bounce. It doesn't look to me like there's anything to do but look for long side entries in here, because all of this looks like it's bottoming, and if it hasn't bottomed already, it's going to bottom in a couple days. And with this pattern that we're looking at here on the weekly, and that bottom in place, and this pattern looking almost complete, and that bottom either in place or going to be soon, you can only be a buyer of the euro when you look at this. And when that's said, you can only be a seller of the dollar when you look at that. /6B, the last of the futures that we're going to look at, and then we'll switch to the cash markets. This is still in this corrective period. It's getting a nice bounce. I don't really trust this. It's still not complete in my mind, and there's likely to be further correction. So let's just look at this. Comes out into here into the early June time period right there. When I switch over to daily right here, this looks like one more dip coming right there, and this goes out to early July. So the weekly and daily are out of sync. And when I see this, it says to me, maybe we get one more dip over the next week or week and a half, and that's it. And maybe you get an earlier bottom here on the weekly. So I'm looking at that. This was on our best for 19 list. And we still think that's the case, that the British pound is going to do much better moving forward. So now we're going to move into the cash markets. US dollar, JPY. It is our belief, and has been our belief, that the Japanese yen was going to have a big move. Let me get this weekly placed properly. Or the dollar would have a big break against the Japanese yen. Right now, you can see with the dollar breaking, the Japanese yen is doing much better. Remember, this is dollar versus Japanese yen. So when it goes down, the dollar is weaker, the Japanese yen is stronger. If you look at the futures, you'll see something similar to this. And now what we're looking at is getting into the support zones. But I really think that this upper resistance sell zone that we had in here was spot on, and that you can see the failures in here. This is a little evening star, that we're expecting to see continued weakness in the dollar versus the Japanese yen, and that it could be very significant moving later on in the year. Here you can see in the daily chart, now this is coming and threatening this little first low right over here. That's not good. It's likely to come down a little further, have a crummy rally, and then move down again. It's in this minor or short-term support zone right there that you can see. So another week of risk, and then maybe a few days of rally, and then more risk. So in my opinion, that there will be a very high probability short sale somewhere out over here in mid-May for a very nice trade setup if you're not believing already on the short side. I just want you to note in here as we talk about momentum, and to me momentum is the key. This upward momentum right in here is ending and then rolling over. So when you look when it started to do that over here in this cycle, well, that set up a very large decline in the US dollar versus the Japanese yen. So it depends on the position. You can see in here it stayed positive the whole way. When it turned negative here, it fell for about 3 weeks. But there would be a lot of time right in here. And so momentum is turning negative when you look at that, and that is key. And when you look in here, it had positive momentum for these last, month, right through this rally, and now the momentum went neutral right over here. So it'll take a few days to go negative, but it lost its upward momentum there in the US dollar Japanese yen. Very significant. And again, it's going to make it very shortable. AUD versus the US dollar, the Aussie did not benefit from the stronger energy prices at all, and now it looks like it broke down in here already, or did it? This cycle might have extended out. I'm not sure. I have this analysis as negative based on what I'm seeing in here and based on the failure in the resistance zones. It's going to take a little time for that to sort out, for me to have what I consider to be a high probability analysis. Now, when you look at these patterns right in here on the daily, so like I say, I'm not sure about this. Did it extend out, and did it make a low from this cycle, and is that just shifting longer? If that were the case, the daily would be in a position of bottoming, but it's not. As a matter of fact, this kind of bear flag that's forming in here suggests it's going to decline out here towards the end of May. So if you look at the end of May on the weekly, that's way over here. There's end of May right there. That says decline through that period. If that's the case, it's almost certain this is negative. So overall, the weight of the evidence suggests the Aussie is in bad shape. And that's bad shape at the same time that the dollar is not in good shape. So that's really interesting. makes the Aussie worse than the dollar based on what we see in here. And the U.S. dollar versus the Canadian, we thought that was bullish and that the dollar would do better than the Canadian. Now with oil softening, you would expect the dollar to do better, and it's not. So you're getting this upper resistance zone being effective in here. Still, we think that there's likely to be more coming in here as far as upside. And when I switch over to the daily right in here, this is one of the prettiest daily charts that we're going to ever show you. And that is that, we had our weekly bottom, the intermediate bottom right in here. These cycles created the inverted head and shoulders. The measurement suggested bullseye right over there where it hit that. And now you see we're in a corrective mode in here that has a couple of days in this short-term buy zone right there. Sometime in the next couple of days, this is very likely to start moving up again right in here. And we're likely to see a dollar move up against the Canadian. Now, even though we think the dollar is not in great shape and it has, a few more days down, well, maybe that's this right in here, and then it will bounce, and that'll make this a very good buy zone, which we think is the case. Short-term traders, I think you put this on your radar, that it's likely to head back up over here to that 135 or higher level, and that certainly is enough for a long side trade. So that's a look at the Canadian dollar. Overall, the dollar in bad shape as far as I see it there. The euro currency in good shape, and until it tells us something different, those are the highest probabilities. And for trades, I think that's important to look at. Now we're going to switch over to the metals. Now, again, we talked about the dollar not being in good shape. That makes the highest probability that gold would be in good shape, that there would be a gold rally coming while the dollar is in this long stair-step downward mode. When you look at this pattern here in gold, and I have the weekly blown up really strongly, there is all of this nested area going on right in here where all of these lows come in. Now, silver's got a longer time period to go, but not by much. Gold, within a couple of weeks of the projected bottom, that means it might have bottomed already, or it might just pull back a little bit, maybe on a dollar bounce, and give you what I would consider to be a high quality entry for this next upward move in the gold market. We're looking at cycle rhythms, remember. So you had these lows that occurred right in here, and then the big rally. I'm following up the dominant cycle right in here, and then the correction, which is the minor cycle right here. So when you have the minor cycle giving you a correction and the dominant pattern still bullish depicted by the configuration, the right-hand translation, all of you that are students of cycles would pick up that when the correction is over with and this starts moving up, it will join what was this upward movement right in here, and you get another blast to the upside driven by these two cycles, and that gives you another move up to, I would say, 1300s, mid-13s to high 13s, getting up back here and testing up near our fib target zone. So that is, we're getting into a very bullish time frame coming in here for the gold market. I'm not a gold bug. I'm just whatever the charts tell me. Now, when you look at this pattern, it's suggestive maybe one more little dip in here, and then turning up. So you have the daily turning up in about a week or week and a half. You have the same thing here on the weekly, and it all points to me that you got to look for upside when you look at the gold market. Silver and platinum are slightly different. Now, silver is getting just wailed on today as it drops off 22 cents, and you could see it continuing on the downside. Like I said, the silver market's a little bit longer in the cycle, and that would give it a couple, 3 weeks before the bottom is made in there, if gold lets it stay down. That's the question. When I look at this is about a week and a half time, so it might mean that the silver market actually will bottom with gold, because the shorter pattern, the daily cycle only calls for a week or week and a half. That would be fine. It would not be that far off based on the principle of variation, and that will give you a low sometime like right around here, which is perfect. And that's you can see the cursor moving on the right also time-wise. So if I go pointing right at this low right over here, you can see where it comes to on the weekly. Time-wise, it's perfectly fine if that's where the bottom comes and then moves up with the gold market. So I think that's setting up extremely nicely in the next couple weeks for a bottom being made and some sizable gains. Take a look here. As you look at the platinum market, you could see it got up into this target zone and beyond, got up into this major resistance zone and resisted. With palladium shortage pushing it up and the fact that it was really extended, you get this very nice pullback in here. I think it's going to continue to decline. Now, when you compare the silver and gold markets, which you have right in here, those with those lows coming in, you could see that platinum really looks like it's going to run past that. Platinum is not the one I would buy. It would be gold first, and then it would be silver. And if you believe that there's a bottom going to be made in those together, remember silver has a much bigger beta. And remember that the miners have bigger betas than both of them. So the miners give you the biggest leverage if you want to buy stocks instead of commodities. No problem there in my mind. So that's a look at the platinum market there on the weekly. Here is your daily pattern here, and you have a breakdown. So what is the breakdown? You have this low right over here. So you have the nested lows right there. And then you had the rallies where this blue cycle moved up and the dominant blue cycle moved up. Then you had this correction right in here that you see made the bottom right here. Now you're in this next rally that failed and now has come down into support. But that points to this decline out over here towards the end of May. And then it may go further out another whole set of cycles. So this right over here is the silver cycle that you're looking at. So we keep that in there to overlay it to see how that looks. Silver, gold, platinum, all out of phase, or platinum out of phase with silver and gold, and likely to go longer on the downside. So not likely that I would be buying platinum under these conditions. I would much more rather short it. And if I were to be doing pairs trades, I'd probably be buying gold and shorting platinum as far as that goes. Now, copper. Dr. Copper, what is going on here? You're going to drive me insane. As you had what looks like the rally come when it was supposed to, right over here, this low right there, we slightly changed this to better align and it looked more positive, but look what it did. It broke down right over here. Is that the China economy slowing down, the world economy slowing down? Is it me not having read this properly? I'm not sure about any of that. I have to take the sum of the evidence that says to me, this looks like a violation of this level. The highest probability is that this rally failed already. And man, if that's the case, that goes out into the fall before you end up making a significant low. So we're going to have to get a little more clarity in here to be sure before I place a red zone in here. It looks that way to me. It really does. That would be a very sad occurrence if that's the case, and it would be very reflective of a problem in the economies. Now, when I look at this is a sick-looking pattern in here. Now, there's a couple of cycles in here that are out of phase. Now, let me show you the out-of-phase cycle so you can understand. So this black cycle right in here, when we changed that, we turned these blue so that we could see that that changed. And then there was a shorter cycle right over here that had a lot of clarity, and that looks like it's bottoming right now, but it's bottoming below this level right there, and that says to us, well, that slipped. So let me just place this properly. For those of you that got our charts today, you might note that based on the roll, this got a little bit lower, so we're going to show you that's the real number right there, and that's okay because it still broke down. So this shows us, because of the breakdown, that while we could get a rebound in here on this minor cycle right there, that's likely to be overwhelmed by this declining information that we have right over here, and that's why we have a failing rally coming. And we think copper is going to be very shortable in that rally. Now, copper is, a very important pattern, very important read to the markets, to the economies. And this overall looks like a problem that I see in here. Now, we want to watch this. It's significant. I want to note right now, as I do this, that as copper is looking at this week, the stock market has really turned south in here, from being up about $7 in the S&Ps to being down about 8, as there's a second thought going on about this Fed. So it's pretty significant as I'm talking about Dr. Copper diagnosing what really may be going on in these slowing world economies, and the stock market giving up their whole attempt at a rebound and moving down pretty sharply right now. It might be something that Powell is saying in the interview, in the press conference. So I'm not quite sure about that, but we'll see, because by the time you watch this, you'll have all the other information about that also. So that's a look at copper and look at gold, silver. I think that money's going to be moving into gold, driving silver, and that is likely to come in the next few weeks. That's likely to be in alignment with a sentiment change in the stock market, where money looks for safe havens, bonds, which I'll show you right now, and in the gold market. So let's look at interest rates. Oops, sorry, I was on the wrong screen there. So let's look at interest rates. And you'll note that, I've talked about the TNX and how extremely valuable that is in helping us understand the condition of the bond market, and the repeating patterns in there that are very, very close to spot on. So this is interest rates, and you can see a look at the cycle lows. That's what we want to look at and how they line up. This low right over here, right? So this low was higher than this. That's why we have the positive configured cycle arrow right there to show you that. That says that when you see that, the odds are high you will take out this number right there. And you see that. Then when you break the cycle low support, it says the odds are you will be in a stair-step downward move, in this case for interest rates, or in this case positive for the bond market, and we had a good bond market rally. So when I look in at this at the weekly patterns, you can see that it fell from what we had in there for a long period of time, the sell zone or the buy futures zone right there, and interest rates began to fall. So this points to about, we'll call it 4 to 6 weeks of falling interest rates. That aligns with 4 to 6 weeks of rallying bond market, and that aligns with what we're talking about as a correction into late May or early June for the stock market. So if money were to be flowing into alternatives for the stock market, it would be the bond market, in other words, declining interest rates, or it would be the gold market, which we just showed you we believe is going to do better. So that is a key look at interest rates right there, which are again in a falling mode for the next 4 to 6 weeks. When I look at it in here, it looks like about a week or week and a half down, and then when I time this out, this is mid-June. So that would be the 6-week period out there for the low in the TNX, or the low in the 10-year yields. Tells you that bonds are likely to be in decent shape through mid-June when you look at that. Now we'll switch over to the ZNs. Now remember, because of the yield curve mess, when we went inverted, these cycles do not line up. ZN is different than the than the TLTs or the 30-year ZBs. Now, even though the cycles are different, the low, which this ZN made right over here and over here, has been influential on the patterns in the 20 and 30 years, and you'll see that as we move forward. So we're now 2 weeks into this rally. We talked about rallying into the mid-June period, somewhere out over here. If it gets through this resistance, then this will extend up. But that's why we have this so far out, so much white space in here, because we believe that there's a high probability it's going to rally time-wise out to that period when we look at that. And you look at the pattern right in here, it made a bottom about a week and a half ago and has been rallying. That is what we expected, and we expect that will continue to give us positive action in the bond market. Interesting, there was just a very big hit in bonds when the stock market fell, and you can see that reflected right in here where this left a big tail. I'm not listening to Powell because I'm talking to you, but I'm willing to bet you he said something in here that scared the interest rate market, and that's why the stock market took the quick hit to the downside. So stock traders are paying attention when you see that, and it would take a break under here in the 10-year at 122.20 in order to negate what looks like a positive pattern that we see in here. So right now, some pretty good volatility movement going on in there. That is, and I'm sure regarding this press conference that's going on. So now here is the 20-year. Got into the support zone, moved up, and being driven up again by the low that occurred in the right over here in the 10-year. The low over here in the 20-year, you could see that. So we shifted out the dashed line for you to see how the 10-years are also affecting it in here. So 10-year low right over here, 10-year low right over here, that's what shows up. And the 20 and 30-year lows were over here. Another look at what we think is going to be a continued rally up into that zone right over there. And it would take a break below this level right here at 122 in order to turn this into a more negative pattern that we're looking at. Really interesting watching this intraday trading that's going on right now, and I'm trying to do that and talk to you. So here we have this ZN low right over here. We have both of these cycles now lined up for you to see as there was almost a perfect minor cycle or half cycle difference right over here, and it's important to see that for cycle analysts, because what we're going to be focusing on is how this next cycle comes to play and what happens after that. We easily could get into some chop and correction in here and then be moving up again out over here into this period of late May and into June. So again, it would have to, we're watching this level right over here around 122.10ish in there to as a key important level. And that is a look at the TLT. That's the 20-year, and now we'll continue moving out the curve to the ZBs that you see right there, and the same pattern moving up in here. This is a yellow zone or a warning that it's a corrective zone because it got underneath this moving average here, and the momentum got lost. So that's why I did that. It still easily could move up here to 149, and I think that is a strong likelihood that we're going to see that happen. The patterns in here, again, you can see both scenarios based on the ZN cycles, and they just give you a correction, choppy period over here for a week, and then attempted moving up again. So even though we're into a little choppy period right now, we still think that the bond market is going to be doing better. And if the bond market does worse and starts to break down from these numbers, and then the stock market listens to that like it just did over these last few minutes, then it's going to be interest rates driving the stock market because they don't believe that the situation is going to be for falling interest rates, or there's another rate cut this year, and we'll let the bond market be our lead on that. Right now, bond market is saying to me that prices are going to rally, yields are going to fall, and that might all be reflective of the stock market going in correction, and all simply technical and meaningless as far as anything the FOMC says. So that's a look at the bond market, and overall, we give the bond market a positive bias in here, that it's likely, even though whatever caused the bond market to give significant ground today from its peak up a point, now up about 10 ticks, It's still, I think, going to be driven by the technicals of money flowing either into stocks or out of stocks, into bonds or out of bonds. So we're going to be watching for that more than we care about a lot about this FOMC nonsense, essentially, that's going on. So now we're going to look at the stock market, the S&P 500. And I promised you a little different look and told my level 4 members that we'd be looking at something important regarding moving averages. So here you could see the stock market trading in this massive megaphone. I mean, it's really clear about that. And usually when you get to the top of a megaphone, you're tired. The market is tired when you get there. Now, the yellow zones are the corrective zones based on these average of about 20 to 22 week cycles that you can see right in here. And I've been talking the last few weeks about the likelihood of, some 75 to 150 point decline coming here in May and into early June. We think it's highly likely that that is going to happen. Just going to get a little sip of water here. And that we're entering into that period pretty soon. Soon, I mean hours to a couple days. In the shorter pattern, I'll show you the immense strength that we've seen. But what I want you to really look at in here, as I go far out, man. As I go far out to these bigger cycles right in here, let's take this out way out there, that when you get really far away from that moving average, the 34-week moving average, you tend to move towards it. It's a magnet. I showed 8 stocks a few weeks ago, 2 weeks ago, that I thought were very far and we're going to have downside corrections. So if you haven't watched that, now is an important time to do that. This, you can see when the market was much lower, the movement looks like it was smaller. And when it stretched way above it, right over here, you can see it cracked right down to it. Stretched above it here, cracked down to it. Stretched way above it here, but cracked way below it, and then rebounded through it. It's a magnet, like I said, and now we're well above it. Well above that 34-week moving average. That is quite stretched, and you can see that I'm really only looking for it to come down and test the 13-week moving average, or a little lower than that. This right now, I see the expected correction, 75 to 200 points. Well, it made a high there of 29.54. This average right now is at 27.54. So that's 200 points back down to the moving average. Getting down to just that 23% right there, which is at around 28.10. Would be a 140 point decline, which is very reasonable to expect over this next 4 to 6 weeks. Slap me on the side of the head. That is a bold call based on the momentum that we've seen, and you can see the momentum in there still very strong. But at some point, you get a down week that's of significance, as you did right in here, and then the momentum changes, as it did right in here. And you end up right there is where it turned down. You can see that, and you end up getting into the bigger correction. So that's, in my opinion, coming very soon, where the market will likely give significant ground. Here's your daily patterns. Now, again, momentum king, momentum not giving up one bit of ground in here. We have the biggest series of swamped cycles that I can remember. I mean, these cycles right in here with this long advance. Now you can see in here, decline due, very small decline, cycle swamped. When it's swamped, in other words, this is being overwhelmed by this. This right in here. This upward strong momentum that's going on through here, if you can create some kind of a channel right there, is overwhelming these declines. It's so powerful, as you can see here in the momentum. Cycle swamped, and the minor cycle in there right now also swamped. And here it is as we look in here, there was a minor low due right in here somewhere. You can see that. Well, what did you get? Some interday declines right here or here. One of these is that low. So I'm not exactly sure what will declare the breakdown in here or the correction, but it would need to really get underneath, let's say 29.15, to really give us a sense, about 30 points down from here, that there is, a significant breakdown in the market coming. So that would tell us, but right now it's extremely strong. But I also want to show you the distance from moving averages in here. Now we clock the 89-day moving average in here as the most significant, and when you get far away from it, you move back towards it, as you did right over here, and then you came down and had that big break through it. When you broke down far away, you rallied back up to it, and now we're very far from it on the upside. We're further from it right over here than we were when it had this break right in here. So we're very overextended when we look at that, and with the weekly correction very due in this period of risk going out to early June, that's this cycle right in here, and then the next one right here, which bottoms June 13th, that's in alignment also with the NASDAQ, that says to us there is risk coming in here during this period. And that this correction, this missing correction, is not very far away when we see that. So that's a look at the S&P 500 and a clear look at how extended this is and how due that yellow zone correction is right there that you could see on the left. NASDAQ, we'll take a look at that one here. Kind of a long video because I wanted to show a lot of things. Look at that upward move right over here, the powerful upward strength, the decline here due until mid-June right there, support at around 73.94, so that takes you down about 420 points to that level right over there. Here is your moving average right down over there. If it wanted to test that 34-week moving average again, that's at 70.70. So that would take you down some 700 and something points during that period. I know you're all saying, how could that happen? This market is so strong, but that happens. And we're very due for this correction. When I look at this cycle right over here on the right, I might as well blow that up for you. That looks to me like this corrects down into the middle of May, and then this one takes you again into the middle of June. So these are lining up to a stair-step ABC downward pattern, but you need to get the break. You need to lose this upward momentum, and this is every bit as strong as the S&P 500 when you look at that. So here's your support zones here. Here's your 23%, 74.09. Here's your 38%, 71.05. Pretty reasonable to expect 71.05. When you look at that, that's a long way down, isn't it? That is a look at the NASDAQ. The Russell just significantly weaker overall on the bigger pattern, as it has made basically what is a double top right in there, but it's not an official double top until you start moving down. And it's shown some weakness recently, and now we think that this is going to bring a break again, and this target would be around 1480, 108 points down from here in these next about 6 weeks, 5 or 6 weeks there. So we're getting into this corrective period when you look at that. And here is the daily chart, and this is the S&P 500 right there in the NASDAQ. And there is a very different patterns in here that are lining up in the Russell. They just are not in sync, because the Russell has gone from its own strength and its own weakness at different times that have kept this from aligning with the broader market. When it gets really weak, the concern is that these companies, which are so heavily in losses, a lot of them will not be able to deal with a lot of economic weakness coming. But we've maintained this strong upward momentum, but this one could break down a lot faster. Again, what we're looking for are declines, this one that comes with the S&P 500 and the NASDAQ, and then the rally, and then its own declines taking over. So once this breaks down here, it's going to be set up for declines into June also in the Russell. So that looks like a market that is definitely a very risky market based on how it's stretched, and it's going to have to lose its momentum in order to tell us that the time is now. Right now, the time is now to wait and to be proven what looks like a market that's ready to stop. Okay, so one more thing to just throw into this is that I think it's important to look at the VIX cycle patterns again. It was just a few weeks ago, maybe 3, that I said to you I thought that there was a little more time before we get into a period where VIX implied volatilities are likely to spike. We are now within moments of that, looking at this. The lows do right in here on the weekly pattern and likely to spike. Again, we would be in the first quadrant, entering the first quadrant right in here of this major harmonic families. In the first quadrant, which isn't often the one that gives you the biggest upside move in volatility, you can see right here 856 up to 17. So implied volatility's doubled. Here you moved from approximately 10 up to approximately 17. So a similar move, not quite a double at that point. So that's important. Here you moved right here from around 10 there up to a high of around 17 here. So we're looking at a very strong likelihood of a 17 reading in the VIX coming in the next month. And then, calming down again, just as it did right in here. Rally and VIX comes down, first quadrant. Rally comes down, first quadrant. Second quadrant, big movement here. So rally, first quadrant, comes down, and that's where you're getting into right now. We're going to look for a 17 VIX coming up in the next month or higher based on what we're seeing in here. Now, when I switch over to this pattern, let's just look at this one harmonic family right here. And now we'll look at this. When you look at that pattern right there, it looks like implied volatility's already bottomed. So in other words, the move from this low over here, which was about 11, up to what we think is going to be 17, 18 over here, has already begun. And that says to me, beware, because you're likely to get some downside in the stock market in here based on what we're seeing. So that is just an enhancement to what we showed you as far as cyclical patterns go. This is an early warning that those upward momentums that we showed you in everything in the indexes are about to go. So we'll see if that alignment works and if it's good proof. For those of you that are still with me and that are interested, we're going to move into the grains and the softs. So here is the here are the grains that we'll start out with right now. Getting a big reversal and a big rally here in the corn market. That it really looks like this cycle shifted, and you can see that, or that this skew that went on here was based on the roll. So in other words, we're in a rally phase right in here, right there, that kind of has this tail there that doesn't belong based on what happened after the roll. So we're moving up, and we move through this resistance right over here, but we think it's going to hit another one right up here. I'll have to put that next one in there. And it's still overall not a lot of strength, but getting a good rebound in there. So it's key to see how it does regarding the next couple of days. In there, and now you can see right in here again this was affected by the roll. You can see the roll right there, and then it's rebounding. So we'll have to wait a few more days to get a sense. We think it's going to fail and come down one more time when you look at that. So that is a look at the corn market. We don't like it. Configurations are negative, and it's getting a rebound now, but I'm not real favorable towards it. And when you look at the wheat market, you can see in here, if this is going to affect the grains at all, this is really, it really looks like it broke down. It's got about a month and a half still to decline. That does not look good. We would sell rallies in there, and rallies you're starting to get. You see this engulfing pattern today. That is that new cycle starting to come up. So next week we'll probably have a resistance in here or a sell, a point to short it, because we're only looking to short the wheat market right now. And the soybean market, which we have the colored phasing in, that turned pretty red. You can see that, and 2 out of phase cycles should have made lows right in here, and you got a crummy rally and then a move down. Now this, of course, always has the risk of that it's pretty early and close to this that it might have shifted, but overall the probabilities are that it hasn't, because this has 2 weeks on the daily chart left to go. So the highest probability is that that breakdown and that red zone is accurate, and that it will likely, any rally in here will not be able to hold. Soybean market, we'll call that looking bad. The overall bottom that we've been looking for, and it's been shifting around and trying to bottom, is still in coffee. This is coffee having the hardest time making a bottom. It's still trying, and it's still above that last low at 89, but really struggling. Now, when you look at this pattern right over here, it called really for one more dip. So if it holds this 89 level and then starts to move up again, we're going to know something. In the meantime, there's no doubt that it is still an extremely weak market, unable to make its low in any significant way, and you can't be very brave when you see that in picking a bottom. Cocoa failed where it was supposed to, pulling back from that zone. We think it won't be able to do a lot better. When you look at this, it looks like it's going to fall for 2 more weeks. So that's what I'm talking about, these weak commodity markets that you're looking at. That looks to me like it's only a sell here if it tries to pick its head up. And cotton is the last one that we'll be looking at here. And there you can see that the cotton market failing right at that resistance zone, likely to be turning over in there and then coming down again towards that fib extension that you see down on the bottom. And here you can see that this looks like a top, and like it broke that support right there. Even though it left that tail, it looks like another week and a half of decline. This looks very shortable, and I want you to note today what was positive resistance formed right in here, and a rally, positive momentum, and a rally has now been lost here at neutral and now turning negative. When you turn negative, that says after this long period of rally that it's likely that rallies will fail, and it's very shortable. So that is a look at cotton, and for those of you that made it to the cotton analysis, good for you for hanging in there. And you're one of the few people that may be interested actually in grains and the softs that we show right now. So if you're still here, let me know if you have a lot of interest in this group that we just did. That's it. I see the stock market chopping around, but really turned relatively weak after during that after the FOMC announcement and during Powell's talk. And I don't think that the markets are happy about something he said. So, but at the same time, I don't really care, because I think that overall what we're looking at is a period where money is likely to flow out of the stock market into other stuff. That is it. I hope you loved it. Let me know. I'll see you in the next segment.